right, welcome to folks who are joining us for this Thinking Big series. Excited to have people coming in. We'll give everyone a minute. Before we kick off, Chris, I was going to ask you about your bookshelf. Have you heard of the Japanese term, tsundoku?
No.
It's the art of collecting books that you may or may not read. I have this problem. I don't know if you do, but you have a very impressive collection behind you.
Thank you. I don't know if it's an art. It's definitely a compulsion. Like it's, when I need to relax, I go walk around bookstores and it's my total love. Yeah.
I love it too. Yeah, no problem.
If I could, right here, from here to here is every hardback book ever published by the investigative reporter Seymour Hersh. That took a lot of collecting. His first book came out in 1968. And
wow.
Yeah, about chemical and biological warfare. And I've got it's my prized collection.
Oh, can you put his name in the chat for us?
Oh yeah, absolutely. I'm not good at this stuff. I just hit the Q&A. Hold on. This guy is one of the most epic investigative reporters of like modern American journalism, kind of post World War II. He's gotten touchy and controversial in the last like 7 years with some stories, but when you look back at the body of this guy's work, he's just one of the great public interest journalists of our time. And I came across it in the 2000s during the invasion of Iraq. He was just breaking these incredible stories about what our government was doing. Incredibly sourced up journalist, hardworking, works in the public interest. Totally amazing.
Wow, incredible. Thank you so much for sharing that. So he's served as a bit of an inspiration for your career, it sounds like.
Absolutely, without question. Total hero, to be honest. Yep.
Awesome. Well, we're just waiting for a few more people to join us, but maybe I will just reiterate a welcome to everyone that has joined. You're at Thinking Big, an Economic Liberties project series featuring authors who help expand our thinking on important topics in economics and policymaking. And I think let's just go for it. People will show up when they want to. So I'm Denise Hearn. I'm a senior fellow at the American Economic Liberties Project. I co-authored a book called The Myth of Capitalism, Monopolies and the Death of Competition. So that's how I got baptized into the world of antitrust and anti-monopoly. And we are so delighted to have Chris Leonard with us today, who's written a phenomenal book. I wanted to just say quickly that about the series so far, Thinking Big, we've hosted some incredible authors. We've had Rana Faruhar, Catherine Judge, Peter Goodwin from the New York Times, Brandy Collins-Dexter, Elizabeth Pop-Berman. Next up in December, we have Cory Doctorow on his book with Rebecca Goodwin, Choke Point Capitalism, so people can sign up for that. And one last thing is, unfortunately, Matt Stoller wasn't able to join us today. My colleague, he unfortunately couldn't make it at the last minute, so he sends his regards and apologies. So Chris is a reporter and author. You sent us the most humble bio. It's 2 lines, barely anything in there, which was that you're a reporter and author who writes about corporate power. You've written three fantastic books: The Meat Racket, Cokeland, which was a New York Times bestseller, and your most recent book is The Lords of Easy Money. So I wanted to just say congrats on this excellent book. You've took something that, monetary policy, very impenetrable, and made it accessible and even heart-pounding at times. What is the Fed going to do next? So why don't you give us a bit of an overview? There's so much in this book. I encourage everyone to get it. Give us just an overview to kick us off into the conversation. I'll ask some questions, and then we'll save the last sort of 15, 20 minutes at the end for audience questions.
Okay.
Over to you, Chris.
All right, will do. Thank you. And thank you so much for having me. The roster of authors you've had is just astounding, like every one of them a great writer. So it's a real honor to be here with that group. Okay, so listen, I understand that when you talk about the Federal Reserve and monetary policy, it doesn't necessarily leap out as like, this is a topic I want to sit down and read a book about for hours on end. But I wrote this book, The Lords of Easy Money, with a really simple goal. I wanted to write something that moves pretty quick and fast, that somebody could read on a business trip at night, because it's easy, but at the end of the day, understand the mechanics of the central bank, how it does what it does. But critically, I really felt an urgent desire to explain what the Fed has done over the last decade, what the Fed did between 2010 and 2020. I think it's a policy story that I felt hadn't really been told. I think what the Fed did affects every single one of us. It's an astoundingly powerful institution that affects our entire economic system and our entire financial system. And in a way, that's like always been true. The Fed was, created in 1913 as the central bank. It's tremendously powerful. Everybody knows that. And the Fed's core superpower, if you will, what makes it so powerful is that the Fed creates dollars out of thin air. It's the only institution in the world that can create new United States dollars. And the thing we call a dollar is actually a Federal Reserve note. And we made the central bank in order to have a currency. Before we had the Fed, we had all these wild currencies. You and I can talk about that. But we made the Fed to make our currency in 1913. But I don't think it's appreciated enough how this term is so overused to say radical, but it's appropriate here. And it's not hyperbolic to say the Fed's policies over the last decade have been radical. The Fed departed from its normal course of operations. And I think there's a good case you could make that the Fed really departed from its central mission and its responsibilities, if you will, starting in 2010. And that's when the Fed undertook these experiments in easy money. When the Fed wants to loosen conditions, it lowers interest rates, it has loose money policies or easy money policies. What they started doing in 2010 really breaks the historical graph of what easy money is. And I'll just give you two quick points on that to describe the scale of the change we've seen and the reason I wrote the book. The first is just interest rates. You hear about the Fed controlling interest rates. Typically, historically, interest rates have floated between 3 and 4%. The Fed kept interest rates at zero for almost a decade. That's 0% interest rates for 7 years between 2008, 2015. It's so interesting to go back and look at the debates. People kind of debated whether that was even possible to keep rates at zero for that long, but the Fed did it, which had this you can't overstate what a dramatic reorienting effect a 0% interest rate has on the global markets, on investments, on debt. But then at the same time that rates were kept at zero, the Fed engaged on an unprecedented spree of creating new money. The best way to measure that is, and I'm sorry if your eyes glaze over, but this thing called the Fed balance sheet, that's basically like the size of the Fed's assets. So when the Fed creates new money, its balance sheet increases. And when the Fed takes money out of the economy, the balance sheet shrinks. It's kind of the shorthand way to think about it. The Fed's balance sheet grew in this slow, steady, gradual, incremental increase for about 100 years. And it grew to be about $900 billion in the first 95 years of its existence. And then between 2008, 2014, the balance sheet grows by $3.5 trillion. So another way to put that is the Fed prints 350 years worth of money in about 5 years. And when you look at the historical graph of that, it's like a hockey stick. And that was just the beginning. When COVID hit, the Fed printed another 300 years worth of money in like 4 months in 2020. Now the balance sheet is $9 trillion, 8.97 last I checked, trillion dollars. That's 10 times more, 10 times larger than it was in 08. This wasn't a neutral thing. The subtitle of my book is that the Fed broke the American economy. I like to think of myself as sort of like a old school, like newspaper reporter type guy. It doesn't like come easily to say something like that, but this money dramatically widened wealth inequality. It created huge fragility in our markets by stoking asset bubbles. And it stoked enormous, probably unsustainable levels of debt. Okay, so that's a huge mouthful, but I wrote the book because the Fed did really extraordinary, unprecedented, damaging things to own it. Okay, they did damaging things over the last 10 years, and I wanted to explain it to people, and I wanted to walk through the mechanics of it. I wanted to walk through the internal debates of why they did what they did, and that's what the book is about.
Well, and I think one of the pervasive themes that comes through in the book so strongly is that all of this extraordinary, effectively economic policy making was happening through a non-democratic channel. That the Fed was making these hugely consequential decisions for the country, and they were sort of being made in these boardrooms, these elite boardrooms that were cut off from the public. The meeting minutes don't even get made public until five years after these decisions have been made. And that as these sort of democratic channels were breaking down, whether it was Congress stalling or electoral politics becoming more dysfunctional, more policy making effectively moved to the Fed. And monetary policy in some ways sort of trumped, fiscal policy in its reach and influence. So can you talk about that, and can you talk about just that theme and that effect on the institutions within U.S. government as well?
Yeah, and I'm really glad you brought that up, because that's a huge part of this story. Is, it's pretty well known that our democratic institutions have been dysfunctional and paralyzed in a pretty significant way, at least for the last 12 years, since 2010, but probably before that. And we kind of rely on these undemocratic institutions to do policy for us. The military handles foreign affairs. The Supreme Court increasingly kind of mediates our domestic disputes. And we've relied on the Federal Reserve to do our economic policy in a huge way over the last decade. The book opens on November 3rd, 2010. And it's not a coincidence that that was the day after the midterm elections of Barack Obama's first presidential term, when the Tea Party takes over Congress. And that's really when the wheels of Congress halt. I mean, they did not do much significant work after that point. And literally the next day is when the central bank, the Federal Reserve, decides it's going to do this unprecedented experiment called quantitative easing, which is just money printing. That's all it is. Quantitative easing sounds really fancy and complicated. All it is injecting new money into the Wall Street banking system. And we can walk through the plumbing of it, but that's all it is. And okay, it's fascinating to me. We need to talk a little bit about how the United States Congress built the Fed, the central bank. We built the Fed in 1913 because we needed a central bank to make the capitalist economy run. We needed a stable currency, and we needed a central bank to kind of be there to short circuit or stop bank panics. And when Congress created the Fed, they made a decision that has a lot of rationale to it, which is that, we need to shield this thing from short-term democratic pressures, okay? Creating currency is a very powerful job. It is also a job where sometimes you have to do a very hard thing. You need to tighten the money supply to fight inflation, which can create a lot of pain in the economy. And so you don't necessarily want people doing that who are running for re-election every 2 years. The great seduction of having the power to print money is that you then use that power to try to get your way out of jams. You print money to try to grow the economy because it doesn't involve taxing anybody or anything like that. And so the idea of shielding the Fed from democratic pressure was that we can sort of have these wise decision makers who run the central bank kind of on a hill, and they're not going to be in the hoi polloi or the dirty, gritty politics of election after election. and they can make these decisions. Now, for decades, the Fed really stayed inside these prescribed lanes. Okay, the Fed had two key jobs: create and manage the US currency, and then if there's a bank panic, print money to bail out otherwise healthy banks if there's a bank run. And really since the 30s, that's what the Fed did. And so it was undemocratic. Geez, we could spend a long time talking about the leadership structure. Let's just boil it down and say the whole thing is run by this committee of 12 people called the Federal Open Markets Committee that meets every 6 weeks. When you hear the Fed cut interest rates today or whatever, that's what the committee, the FOMC, did in Washington, D.C. As you pointed out, when this committee meets, they debate for 2 days in secret behind closed doors. The basic summary of those meetings is released, I think, after like 3 months, where it's just super skeletal, like we talked about inflation and decided we needed to do something. The actual transcripts are released after 5 years. And for a long time, they actually didn't even release transcripts. But the Fed was undemocratic for decades, but because it stayed inside these lanes of activity, I think it mattered a little bit less. But when the Fed in 2010 says, okay, Congress is totally paralyzed, the economy is still weak, unemployment is still high, above 9%, we're going to print $600 billion in quantitative easing to juice the banking system. Well, that's when the Fed starts to really expand its authority and its writ and its intervention in our lives. And that's the story of the last decade, is this non-democratic institution has taken on very profound policy decisions that affect all of us.
Well, and I think to your point, it's interesting because in some of the early bank panics, it was JP Morgan who sort of single-handedly saved the banking sector by bailing them out, right? And people realized, okay, well, we don't want to be just relying on one guy. That's extremely undemocratic. And so the creation of the Fed actually had a lot of popular support with progressives because they saw it as a better system than what they had at the time. But as you say, that mandate has evolved over time and has expanded in these really unprecedented ways. I'm wondering if you can draw a line for us going back to quantitative easing and this sort of easy money, cheap money sloshing around in the market. Can you draw a line for us between that and these sort of insane asset bubbles that crop up over time, whether it's the dot-com bubble, the housing bubble, fracking, and perhaps most recently crypto, if you want to take us that far. But yeah, talk about what the kind of incentives that all of that easy money in the system created for financial institutions.
Yes. Okay. Again, this is really how the book started for me. Let's talk about how these easy money policies and quantitative easing pump up stock and bond and other asset prices and create bubbles. We've seen many bubbles crash. I'm 47. So in my adult lifetime, we saw the 1999 dot-com bubble burst. Then, of course, we saw the mother of all bubbles, the housing bubble in 2008 burst. And what we're witnessing right now is what the Wall Street types call the everything bubble. I mean, what the Fed did for 10 years pumped up asset prices across the board. And let me explain why. Okay. It's a dual effect of keeping interest rates at zero and quantitative easing. And let me just explain what QE is. It's so crazy. It's fascinating. So the Federal Reserve has a trading desk in New York. The New York Federal Reserve Bank, there are 12 Fed banks. They're kind of like little mini states. And the one in New York has a trading desk. I've walked around and toured the trading floor in New York at the Fed. And there's literally one office in the corner where the Fed executes quantitative easing. And here's what happens. You've got like a 20-something-year-old trader who sits down at a desk inside the Fed, and that trader will call up a bank. 24 banks have a special license to do this with the Fed. And it's like JP Morgan, Goldman Sachs, Wells Fargo, go down the list. It's all the usual suspects. So the Fed trader calls up JP Morgan and says, hey, I want to buy $8 billion worth of mortgage bonds from you. And so JP Morgan says, fine, here you go, sells $8 billion in mortgage bonds to the Fed. And then the Fed trader types into a keyboard and $8 billion just appears out of nowhere in JP Morgan's bank account at the Fed, called a reserve account. So quantitative easing is just repeating that transaction again and again until, to take the first round, well, it's God, people hammer me for this. The second round happened in 2010, but it's the first round of its kind. The big QE round in 2010 created $600 billion inside the 24 reserve accounts on Wall Street by doing this transaction. That was just the beginning. They kept doing it. The Fed kept doing quantitative easing. They did it to the tune of 2.5 trillion between 2010 and 2014, which added to some money that was already there that they created for the financial crisis. So $2 trillion gets created on Wall Street at the very moment that the Fed is keeping short-term interest rates pegged at 0. Okay, so what does that mean? This money needs to find a home. It needs to find a place to be invested. And I like to think about this from the point of view of like a hedge fund or a pension fund. Let's say I'm sitting at a desk in New York, I've got all these people coming to me asking for my money as investment. I've got an oil drilling company from Texas saying, hey, we want you to give us $1 million. Okay. So if I've got $1 million, if interest rates are at like 4%, I can just save that money for 4%. Okay. And if you're coming in my door, you need to be pitching me a plan that returns higher than 4% to me to make it worth my while to not save that money and give it to you. During the decade of QE, you've got trillions of dollars flowing into Wall Street, while as a hedge fund, I can't earn anything saving my money. 10-year Treasury bill yields are like tiny because of what the Fed is doing with interest rates. So all this money starts going into these risky assets. Like the oil fracking person from Texas doesn't need to make that good of a pitch anymore. It's not a 4% world. It's like a 2% world. So I'm like, okay, fine, here's the money. Of course, this is an oversimplification, but this is real. The Wall Street types call this whole effect, they call it the search for yield. This was like the defining thing on Wall Street for at least 10 years. And so all this QE money was chasing yield and chasing assets. It went into shares of Facebook, Apple, Google. It went into commercial mortgage-backed securities. One huge place where this money went was corporate junk debt. Corporate junk debt simply exploded. It's like the housing bubble in the sense that these companies with really rotten balance sheets and bad business plans were getting billions of dollars in loans because the people with the money needed somewhere to put it. So this is how quantitative easing drives up asset prices. It pushes the investment community to invest in stuff they would not invest in a 4% world. And it helps explain the absolutely, this is opinionated, but the like preposterous economic dynamics of the 2010s. The doubling of the stock market, the explosion of corporate debt values, the high price of luxury apartments and fine art during a decade when productivity growth was totally weak, wages were flat to negative, comparing how you really slice that pie. Economic growth overall was not great. It was very anemic, but these asset prices were just frothing. That's quantitative easing. The Fed, that's what the Fed was doing.
Well, and I think what's so extraordinary about this was, and I'm going to ask you to walk through the Fed's logic in terms of why it wanted to pursue these policies, because at Economic Liberties we have a side project essentially in taking aim at econometric ways of viewing the world and looking at the projections of economists and how how they're often no better than sort of astrologists in many cases. And what would motivate the Fed to engage in such risky and really untested kinds of economic engagement or intervention? What were they hoping would happen?
Such a great question, and I really want to make sure we don't let that topic go of how rotten a lot of these econometric forecasts and reports were inside the Fed. It was really shocking. And there's some great studies that have been done recently showing how consistently off base the central banks were in their forecasts. And they weren't just wrong, they were always wrong. I'm sorry, they were wrong a majority of the time in the same direction, which is that, hey, if we do this quantitative easing, it'll boost growth and we'll be able to stop it when we want to. Totally faulty and incorrect assumptions. And yet they kept making those mistakes again and again. And the National Bureau of Economic Research concluded in their study that there was a political incentive for the people doing these studies to support the policy. Okay, so I mean, I think that drives to the heart of your question. Why would the Fed do this? What were they going after? What did they want to see? Why would they do a policy that was so risky? And, it's really interesting. We talked about the transcripts of the debates and how they don't get released for 5 years, but they do get released after 5 years. And if you have enough like fortitude or self-loathing to sit down for days at a time and read through these like really sometimes tedious, but other times like shocking and fascinating debates, you get a picture of what was going on, a pretty clear picture. And honestly, thank goodness those transcripts are there. So in 2010, just fascinating. I just can't overstate enough how interesting this is. Like, this committee of 12 people is sitting down and they're debating, what do we do now? Okay, the financial crisis is over, but economic growth is weak. They knew it was going to be weak, by the way, because we just had this debt crisis. And they didn't expect a recession, but it was just this really gray, anemic period. And the chairman of the Fed, Ben Bernanke, his memoir was entitled The Courage to Act. And I really think that captures like Bernankeism. He was a student of the Great Depression, and the big lesson from that Great Depression was that the central bankers were too tight for too long, and they prolonged the economic crash. I mean, I've got to say, though, that like the lesson he took from that, it seems, starting in 2010, was that, we don't need a New Deal. We've got quantitative easing. Like, in other words, starting in 2010, Bernanke's saying, we're going to boost economic growth, okay? There's no Tennessee Valley Authority thing happening. We're not going to build a Hoover Dam. We're not going to build schools, but we can juice the banking system to create jobs. Like the Fed, again, their one power is they can create new dollars. And so Bernanke was saying, we need to do this. And very importantly, I have to point out, there were multiple people inside that committee at the time saying, this is super risky. Kevin Warsh, Charles Plosser, the main character of my book, Thomas Honig, Jeffrey Lacker, these people were saying, this policy, first of all, is not going to create that many jobs. Literally, the unemployment rate will fall 0.3%. Was it 1/3% or 0.03? It was a tiny amount. I think it was 1/3% if they printed $600 billion in the banking system. That's how much it was going to bring down unemployment. But what these people were saying is, you're going to create asset bubbles. All this money is just going to juice up risky assets. And at the same time, once we start doing this money printing, we're not going to be able to easily stop, because when we stop, it's taking the Kool-Aid away or the punch bowl or whatever, and there's going to be a market crash. But Bernanke's argument again and again was, hey, I hear you, but there's a risk to doing nothing as well. We must be caught acting. And so look, their incentive was to bring down unemployment rate. I would put my own lens and color on it, and also say it was to be seen as doing something. It was like to not get credit for trying to drive economic growth, but to react in the moment and be seen in the headlines of the day as like we did something. Incidentally, the Fed's own study went back to the great inflation in the 70s and said that same dynamic was going on back then. Federal Reserve leaders are shielded from democracy, but they're human. They read the papers, they watch TV, they want to be seen as doing something. So that's why they did it. It was their one tool they could use to try to juice growth. But I can't overstate enough, they knew at the time that this was going to be pumping up asset prices, which helps the wealthy hundreds of times more than it helps the working class. And they knew that they were building up long-term systemic risk along the way.
Well, and I think that is one of the things that's so profound about how you've told this story, is it comes through so clearly that the Fed was willing to take these sort of, extraordinary risks for these extremely marginal and speculative economic gains in terms of lowering unemployment rather. And, it's always struck me as so disingenuous, because anyone who studied economic history knows that, of course, labor has so little power relative to capital in terms of its earning potential. And so they were so explicitly focused on, trying to reduce unemployment, meanwhile causing these huge asset price inflations. Like they knew that it was going to cause massive inequality in the country, but didn't really do much about it. And I think the other thing I was going to say, going back to our point about economists, I found this kind of anecdote that you shared in the book, I found just extraordinary, which was after one of the Fed governors, Richard Fisher, who had been quite he had been sort of quite hostile to some of the rounds of quantitative easing and dissented, a few times. He shared an anecdote about talking to actual CFOs and CEOs of companies who were saying, we're not going to use this money to reinvest in our workforce. We're not going to use this money to, retrain our workers or invest in CapEx or, do anything that would actually provide sort of growth and new innovation. I'm going to use it on stock buybacks. And Bernanke said, who, by the way, now has a Nobel Prize in economics, said, I want to urge you not to overweight the macroeconomic opinions of private sector people who are not trained in economics. And he totally dismissed that, right? And said, we're not going to listen to CEOs, CFOs who are actually telling us explicitly what they're going to do with this money. You need to listen to our macroeconomists who are PhDs who have never been in the real world, So anyway, I just found that so telling. I thought that was just fascinating. And this was, you could see that this sort of permeated the culture of the Fed.
Without question. I mean, can you imagine how I felt when I went back and read that in the transcripts? Particularly seeing what has happened since then. I mean, the guy you mentioned, Richard Fisher, first of all, like, he's a conservative former investment banker, okay, who literally like slicks his hair back, wears cowboy boots and pinstripe suits. He is not a left-wing populist. And he's sitting here at this table at the Fed saying, all you're going to do is juice up the profits of the private equity firms and encourage stock buybacks. And all you're doing is helping rich people. I mean, that's how crazy the situation was. And then you've got the Nobel Prize winning, not at that time, just the, PhD economist, celebrity chairman of the Fed saying, let's not bring anecdotal evidence into this room, like, don't quote people who don't have a PhD. And I have to rush in and point out that the quote you just brought up was happening in 2012 when they were having this huge debate about doing yet another round of quantitative easing. Okay, this is when I really broke with them, to be honest. Like, they'd done these rounds of QE, it wasn't really working, and people who were talking about the risks, their voices were kind of getting louder and louder, but Bernanke was pushing them to do it anyway. And I think it was at that exact meeting with that Fisher quote. If not, it was pretty close to there. The head of research at the Fed, Seth Carpenter, presents this analysis that the Fed's New York team did. Okay, the crack team of the best economists, and they present this study, and it's a forecast of what's going to happen if they do another round of QE. And so I'm looking at this study in the year 2020, 8 years later, with the benefit of hindsight, and it is comically incorrect on every major point. They were wrong on what inflation was going to do. They were wrong on how quickly they were going to be able to stop. They were wrong on mortgage rates. They were wrong on interest rates. And so this notion that like you need to listen to the PhDs here is proven to be erroneous, like just in the moment. I mean, they were totally wrong.
No, completely. It's kind of incredible how wrong they really were, although not that surprising. So you brought up private equity. I want to bring the conversation there, which, you know, today, not many people I think realize this, but today private equity controls double the amount of companies that are as publicly traded in the US. And, you know, the industry's assets last year grew to an all-time high of 9.8 trillion. So tell us a little bit more about how the Fed sort of stoked this fire of risky debt and the explosion of PE in particular, and what some of the consequences have been. And as a side note, I found it so interesting to see Jerome Powell's connections to private equity and how you traced that through the book. So yeah, what are your thoughts?
Well, I would like to start there. The current Fed chairman, Jay Powell, started his career in private equity. I'm sorry, he started his career. Yeah, he graduated from law school. He grew up in suburban DC. He graduates from law school and almost instantly goes into Dillon Reed, this finance house in New York. But he became a multimillionaire working at Carlyle Group, the very influential private equity firm in Washington, DC. And so in that industry, Jay Powell becomes kind of one of these engineers of corporate junk debt that uses it as the fuel of private equity profits, and becomes probably the richest chairman in Fed history. The disclosure reports make it tough to nail that down for sure. But that corporate junk debt that fuels, you know, Jay Powell's own personal fortune and the private equity industry is sort of like at the core of what the Fed was doing with 0% interest rates. And I've got to like kind of express my little agitation here as a reporter that I don't think that was reported enough. I don't think it's written enough. And it's not like Jay Powell is corrupt in the sense that he's taking payouts. But when you look at like the large institutional incentives and pressures and networks of people talking to each other, the fact that this guy made his fortune in private equity, and then that's the very industry that the Fed not only stokes up through its policies, but then bails out when they start to fail in 2020. To me, that's just a remarkable story that a lot of people, I wish, would write about. So quickly, the business of private equity is often kind of portrayed as this business of, business management. Like, hey, I'm a private equity guy. I'm going to buy this company. I'm going to strip it down. I'm going to invest maybe a little bit here and there. I'm going to make it more profitable. Then I'm going to sell it. But like in reality, I do think it's fair to call them debt engineers, because really the key skill set, I don't totally want to just bash on private equity people all day, but like the key skill set they have is organizing debt issuances. Because here's how it works. If I, Chris Leonard, want to buy a tire company in Kansas City as a private equity firm, the key thing I do is borrow millions of dollars at least, and then I put that debt onto the company I buy. And then the company's annual sales pay off the debt. And I just kind of manage that machine. It's like buying a house that can earn money and pay its own mortgage off. And you kind of own it for a little while and let it pay down as much debt as you can and then sell it. Now, again, when the Fed is keeping interest rates at zero and it's pumping trillions of dollars into Wall Street, that is supercharging the market for debt. That is supercharging the kind of corporate junk debt loans that private equity firms use to go out and make acquisitions. And I profile the business deal, the private equity deal that made Jay Powell rich. And it's a perfect case study of this. I mean, they got all this corporate junk debt. They loaded it on top of this like old school kind of industrial conglomerate in Milwaukee, this company called Rexnord. They load this debt onto Rexnord. They use the debt to do mergers and buy other firms and turn it into this kind of debt-laden Frankenstein's monster. And then they sell it to another private equity firm, earning like $900 million ballpark. They double the price of it. But then this company itself, Rexnord, is loaded down with billions of debt. This company pays more in interest fees than it earns in profits every year for like a decade. And again, this whole system works when debt is extraordinarily cheap. And you can keep reissuing, or what they call rolling that debt on the firm. And again, this is one of the very tight spots we're in right now. Not to jump ahead too much, but as everybody knows, we're in this environment right now where the Fed is being forced to tighten up. They're being forced to raise rates. And all these super heavily indebted companies with all this corporate junk debt on their books are going to face higher interest rates. Exactly like people who got adjustable rate mortgages in the 2000s and who all of a sudden were like, I can't pay this mortgage. I'm walking away from this house. It's like that, but with companies across the country.
Right. Well, and I think what people don't realize is that banks or private equity, they don't actually want companies to pay back their debt. Right? That's the thing they don't want you to do. I mean, fully, because they want to earn the interest on the debt. If you pay back your mortgage, then the bank just has to go off and find somebody else to give a mortgage to, right? They would much rather you continue to pay the interest on the mortgage over time. And so it becomes this game, as you talk about with private equity, of sort of holding on to an asset, holding on to a company, extracting, interest payments on the debt, extracting what you can using, efficiencies like layoffs or shipping the manufacturing overseas or whatever is kind of a cost cutting, and then just being able to find a buyer on the other side that's going to purchase it. And I don't know if you've been following recently, but I recently learned about continuation funds, which are private equity firms have a fund with a company in it, and then they actually, maybe they're not quite done with the company, and so they sell it to themselves into another fund that they have called a continuation fund. And then that way they can sort of juice the numbers to say, oh, we got a return on this, and they can return capital to the investors in the first fund, but they still hang on to the company. And there's increasingly, a number of these deals going into continuation funds, which are another way of saying they're selling it to themselves, which is just amazing. So anyways, wanted to get that in, but you were bringing us to today. I wanted to, we have a few questions here. Maybe I'll just get one more in before we go to the chat, which is just bring us to today, bring us to, kind of what we're facing. The Fed has been aggressively hiking rates. I think they're now, 3.75, 4%. What are you hearing now from your community, the people you talk to, about how the Fed's movements at this point are affecting, financial and economic fragility? Obviously, inflation is quite high. Finally, price inflation caught up with asset inflation. What do you see sort of in the years ahead?
So we're in a very bad position. I think it's fair to say, and I guess let me put it this way. When Ben Bernanke's book came out in 2015, at the end, he's like, look, I was right. Quantitative easing was great. We had economic growth, and hey, the people who said that there was going to be an asset bubble or inflation were just dead wrong. Well, that's writing about the end of a football game at the halftime or whatever. It just doesn't make any sense. And all these risks have been building up, and they really started to become apparent when COVID hit. COVID was a once in a generation wild global economic catastrophe. So it was real for sure. But the fragility in the financial system that the Fed had created through quantitative easing made it much, much worse. That's why a large reason why we're seeing a financial crash along with the COVID crash. I kind of walked through the details of the treasury market seizing up, which is a crazy thing nobody thought was possible. All that happened in March of 2020. Okay, this is a long way of saying the Fed has been expanding and expanding and expanding its balance sheet, putting off the day when it's ever going to have to tighten. And when the Fed blew its balance sheet out to 9 trillion in 2020, I think our best hope was that, okay, hopefully they'll have 10 years to kind of unwind this. And, I don't want to walk through it all, but like, it is very hard to shrink a balance sheet once you build it. It's very hard to withdraw all that cash from quantitative easing once you've put it into the banking system without creating massive short circuits and crashes. So what the Fed really wanted more than anything in 2021 was for things to kind of equilibrate and calm down, and then the Fed would have 5-10 years to draw down its balance sheet to gradually raise interest rates and maybe get out of this thing smoothly. Price inflation really destroyed that option, because when consumer prices are rising 9% year over year, as they were over the summer, the Fed has got to tighten. They've got to raise interest rates or draw down the balance sheet if they do not want inflation to really embed itself in the economic system and continue to gather strength. And then you're talking inflation of 13%, 15%, 19%. It gets pretty brutal pretty fast. And this happens. I mean, it happened in the 70s. It's rough. It's not good. I'm not like a right-wing hard money guy by any means, but inflation is really, really destabilizing and bad and not good. It always rises faster than wages, almost always. Okay. So the Fed is in this position of like, oh my God, we've got 9% on inflation. We've got 9% inflation. We need to hike rates really fast. Well, that already we're starting to see that is like detonating the fragile towers of debt that the Fed has built. It's bursting the bubbles. That's what started happening in 2022. And I'm telling you, it's intense. It doesn't always translate, but when the Prime Minister of England, Liz Truss, passed a tax cut that was unfunded, which, like, let's face it, that's like standard operating procedure. Who funds a tax cut anymore? It's 2022, But when she did that, the British currency plunged in value and their debt spiked because of this environment we're living in right now. When the Fed starts to tighten, when it starts to raise interest rates, when it starts to withdraw this cash, all of a sudden, we live in a different environment where fragile, unfunded liabilities start to become really risky. Capital flees from the British, their version of the Treasury bond is called gilt. And investors fled from the British gilt in a way that the Wall Street Journal said you'd expect to see in like an unstable emerging market nation. What I'm saying is the consequences of the Fed's tightening are scary, and they're very large scale. And when the stock market rises like it's rising right now, it's up like 7%, strictly because Wall Street has decided the Fed's not really going to tighten. So if the Fed doesn't tighten, we'll be able to kind of continue doing this for a few years. But if the Fed does tighten, the consequences of what they've been doing over the last 10 years will manifest, and it's going to be pretty ugly.
It's like the perpetual kicking the can down the road.
Yes, it is.
Okay, we've got a couple of questions in the chat I want to get to here. We have two on private equity. So one is, if rates stay high for longer periods similar to the late 70s and 80s, will we see PE firms leverage buyouts slow down?
Oh, totally. Yeah, it's like the punch bowl is gone. The buyouts will slow, and I mean, but even more dangerous is that, yes, merger activity will slow, buyouts will slow, IPOs will slow, but the real problem is when you're going to start seeing companies default on their debt. Because as we've been talking about, you lump this debt onto the company, you want them to not pay it back because you're earning interest. And, you know, if you work for the finance industry, you're packaging and reselling the debt. The key is these companies, corporate debt is structured in this funny way where you borrow $1,000, and over the course of a 1-year junk debt loan, I'm using fake numbers here, but you borrow $1,000 and you only pay the interest on the loan, and then at the end of the term you pay back the whole $1,000 at once. It's not like a credit card where you pay it down bit by bit. So what this means is these companies have these huge debt loads that they have to either pay out entirely when the loan is over, or they resell it, they roll it. And that's how this whole thing works, is you keep rolling the debt. But when interest rates rise and then stay high, if they stay at 4 or 5% for a year, these companies aren't going to be able to roll their debt without incurring massive costs. And that's when you start seeing the defaults happen. And people are very worried about that. It'll be exactly like when interest rates rose at the end of the 2000s and the housing bubble collapsed.
And someone's just asked, would those ripple effects extend, this is Amanda, from companies with debt to states and or pension funds?
I'd look, honest answer, I have no clue. And I think that's the best answer for a lot of this stuff, because that's sort of like asking how far will the contagion go when subprime mortgages start to default. And I'm not saying that there are all kinds of crazy derivatives built up, but you know, pension funds, I can speak to. State balance sheets and state level debt, I have not reported on. I have no clue. But pension funds have been driven. They were one of the key people hammered by the search for yield. And you see articles everywhere about them having, you know, purchased these risky loans and assets, and they could be in real trouble. But now to get into specifics is when I'm really out of my element, because I can only speak to sort of the high level picture of what the policies created, but predicting where the explosions are going to be is very difficult on a specific basis.
I mean, I'm familiar that pension funds definitely have allocated huge amounts to private equity, to your point, because they didn't really have anywhere else to go. And there was a really strong narrative by private equity that they generated higher returns. There's been some interesting research that says that actually once you subtract the fees that private equity managers charge, that they don't actually do that much better than if you would have just stuck with like an S&P tracker or something. Wow. So anyways, I do think pension funds will be hit significantly. The other question here was around private equity and housing. I don't know if you've looked into this, but Julie's asking about private equity buying a lot of homes and apartment buildings and what effect that will have on the values of the newly acquired assets. She said, I know it takes a lot of housing out of the market, causing prices to accelerate since demand is so high. Is this what was intended?
Yeah, that is what it's intended. I mean, in the sense that what the Fed intended to do was drive up asset prices to try to stoke economic growth. And the housing market is an absolute classic example of an asset market. One point I guess I have failed to make that's important is that we talk about inflation of consumer prices like hot dogs and television sets and things like that. But asset prices can be inflated. When we talk about these asset prices rising, I think of it as asset inflation. And the housing market has seen inflation rates, I'll call it an inflation rate of like 19% year over year. And that's because these investment firms are chasing yield wherever they can find it. And that's why you see, isn't BlackRock the one that got really aggressively into buying single unit houses and these real estate holdings, some giant
Blackstone, maybe?
Blackstone, I always get them mixed up. And so they're pushing into this space and buying up the inventory because they figured out how to do it, and it absolutely drives the price up. Where that leads, again, that's an open question that's very tough to answer, except that when you hike interest rates almost by necessity, the price will fall because demand for buying is going to dry up because people can't borrow to do it anymore. We're not seeing that in a super acute way, but it seems almost inevitable.
Okay, thank you. I want to sneak in one last question here. Amanda's asking if this is not the one I want to sneak in. This is a second one. But would you recommend the book Creature from Jekyll Island, which I also tried to read, and then I realized there's probably better books to read potentially, but I'm curious what you would say to that.
I have not read that thing. I read Secrets of the Temple by William Greider, which was a very heavy lift, very long book. And then I read this I did not read the entire 3-volume history of the Fed by Alan Meltzer. I read chunks of it, and that was a good history. The Man Who Knew by Sebastian Mallaby is a very good history of the Fed during the Greenspan years. But I've got to confess, I did not do the Jekyll Island book. That seems to be like the standard Fed book out there. I mean, why did you stop reading it?
Well, I stopped because it started out really well and I found it fascinating. And then it kind of started to lure into like slight conspiracy rants. And then I realized that the author had written subsequent books on, I think, like 9/11 conspiracies and things. So I think there's probably more authoritative and sort of historical takes, but it is a very popular book for people to read.
Okay. I'm going to get myself into trouble for no reason, but first of all, the Fed lends itself to conspiracy theories very easily because when you have an undemocratic institution that has such like wide-reaching effects, I mean, it sounds conspiratorial. 12 people are in a room making these decisions, and then prior to even them getting in the room, I mean, the Fed governors talk to me about this openly, that the chairman calls the various governors. They have these one-on-one conversations with each other. They figure out how they're going to vote before they ever vote. Okay. Mm-hmm. But the way I said I was going to get myself into trouble, there are so many bad books about this stuff out there. There's this guy, Jim Rickards, who did the currency wars. I was so fired up to buy those books. And I found them
I read one of his books once.
I found it totally unsatisfying. Did you like it?
I read his one about COVID. So I can't even remember what he said, but he was predicting like a third wave and all this stuff. Yeah.
Yeah. I read his Currency Wars was unsatisfying, and I don't feel like it captured the deal. I feel like, anyway, I pick on a lot of these people in the book because there's just so much bad writing about this thing. And heck, I guarantee you there are a lot of people who think I've fallen into the school of terrible writing about the Fed. No doubt about it. Like, you know, some of the better credentialed Fed reporters probably think that, but like whatever. It's a pretty straight ahead reported book that flies pretty close to the ground and writes about what can be verified and what people said. And I think one of the big benefits of being a reporter is talking to people inside the institution, and then the people on Wall Street who actually like trade on this stuff was very helpful.
Totally. We are over time. I did have
Sorry.
one last question. No, are you okay to stay on for 2 more minutes?
Great, man. This is my Tuesday night. Yeah.
Okay, perfect. Me too. So one of the things I wanted to ask you about, something not in your book, which hopefully is okay, which is I've been really intrigued after my sort of side interest in trying to understand the Fed and monetary policy, became like a little bit of a side hobby, was there's been a lot of proposals over the years, some of which actually you talk about in terms of Honig, which is a central character in your book, who dissented at the Fed quite often, and then went to go was vice chair of the FDIC, have put forward various proposals that would actually be really helpful, regulating the banks differently, breaking up the big banks because they're so concentrated. One of the policies or proposals that I found really interesting was from Saul Omarova, who was nominated to be the comptroller of the currency under Biden, but received so much Republican backlash that she eventually withdrew her nomination. But one of the things that she proposed that was really scandalous to people was this idea that perhaps you could create almost like a public option for banking for people, where they could open a bank account directly with the Federal Reserve, and they could bypass essentially all of these primary dealers, all the big banks, the Wall Street banks. And you could see why the big banks would not like this very much. And that's why she got so much pushback. But I'm curious if there's any proposals like that or solutions that you've sort of looked at since writing this book that you find compelling as ways that might kind of disintermediate, this really undemocratic and sort of elitist, way that we do financial, policy or, monetary policy. And I'm struggling for words here, but you get the gist of what I'm saying. How could we reform this differently that would actually work for the average person?
Well, and I'm not just saying this, your group has a lot of good thinking on this stuff. It's a bummer Matt Stoller's not here, because I've seen him talk about this in really interesting ways. And as you're talking about all this stuff, first of all, I think that idea that you just mentioned, how do you say Omarova's first name?
Oh, I probably am mispronouncing it because I just read these but it's either Saleh or Saul, Saule.
Yeah, Saleh, like that's a brilliant idea. It's really important and really smart. And what's so interesting is, the public policy motivation to start the Fed came from the Populist Party in the 1900s, the actual Populist Party of like the farmers in the Midwest and all that. And they were talking about this there were multiple ideas they threw out, but one of them was a decentralized US Treasury. And since we're such an agrarian nation back then, it was going to be like grain silos as treasuries, all this stuff. But that's very creative thinking. And I want to point out the system we have now was created by the bankers and senators in 1913 to make sure that the central bank, the Fed, didn't displace Wall Street. And so the Fed, because of the very way it's built, it can only push money into the economy through the 24 primary dealers, the 24 biggest banks on Wall Street. That wasn't some design handed down from the heavens. That was a policy decision. And it would be, I think, quite beneficial to interrogate it. And I need to point out again and again, quantitative easing, as they did it, is not Keynesian. It's not like giving money to the broad population to stimulate spending. Keynesianism is giving someone a job to build a dam or dig a ditch by the side of the road, and then they get that money and they go spend it in their community. That is more along the lines of if we allowed people to open accounts at the Fed, and if the Fed had done quantitative easing by printing money in the checking accounts of like wage earning Americans, the money would have flowed out into the middle of the economy and stimulated spending there, which frankly, I think good case to be made that would have been 100 times more beneficial, 1,000 times more than giving it to Goldman Sachs. So in a headline, there is not a lot of good creative policy discussion around the Fed. And I mean, you could probably apply that statement to a lot of sectors of American society today. And that's just a whole nother conversation, but like there should be. I speak from personal experience. The right wing of the country hates the Fed, wants to see it gone. I think the establishment left in America sees the Fed as an ally, as an institution that can drive growth and help working people, which I disagree with. But then, you know, of course, the broadest segment of the population doesn't know much about the Fed. And the Fed's been very intentional in keeping it that way, in how they talk about their policy. I mean, my goodness, try asking the Fed chairperson a hard question. Let me tell you from like personal experience, it's hard. They don't do like public stuff. They do a press conference that's hyper orchestrated and performative and not great. The Fed should be more in the public square. There should be a vigorous debate about policy ideas that are structural, like the one you just mentioned of opening broad-based accounts. And I just want to, I know I'm talking a lot, I'm sorry, but like the guy in my book is a small c conservative, Tom Honig, the guy you've mentioned a couple of times. He voted against all these policies, and he's a conservative guy. But when he joined the FDIC, as you mentioned, he came into town in DC with a plan to break up the banks because it was like economically unhealthy to have 5 mega banks control this much of the finance system. And he got kicked out of town, basically. He really did, by Trump, by the way. Anyway, these ideas that confront power have a short shelf life. Let's put it that way. You know, if you really start talking about like changing the structure, the conversation gets a lot harder. And I mean, I remember what happened to Omarova. I'm so sorry if I'm mispronouncing her name, but some senator like accused her of being a communist. Wasn't it the guy from Louisiana or something? I mean, just obscene stuff. And it belongs to the people to debate these things. Yeah.
Well, absolutely. And I think, you know, that's our whole sort of reason for being at Economic Liberties, is to challenge these concentrations of corporate and financial power and the gatekeepers that effectively are imposing their private regime on the economy. And so, you know, I think that the awareness that you have developed through this book is fantastic, because it gives people a basis from which they can start to envision alternatives. And I think there's nothing more powerful than that. So I really encourage everyone to go get the book. I really loved it. I read it so quickly because I was absolutely hooked. And I'm not just saying that. I have book ADD. I normally only finish a third of books, but I was really loving this one. Yeah, and if you know, if people, as I mentioned at the beginning, would like to sign up for more of these talks, they can do so on economicliberties.us. And we've got Cory Doctorow coming up next in December. And yeah, is there anything you'd like to leave us with, Chris, before we all hop off and go to dinner?
No, enjoy. Thank you for taking time to think about quantitative easing. I really appreciate it. And thanks for having me here. And good luck with your work. I really enjoy AELP's work for sure.
thank you so much, Chris. We're so appreciative of your time and of you explaining all of these crazy acronyms to us.
Yeah.
Deeply grateful for all the great work that you've done.
All right. Well, thank you.
All right. Take care, everyone.